All right, let's be real. Going through a divorce is a lot. And the last thing you probably want to think about is taxes, right? But the truth is, your entire financial world has changed, and the IRS has a whole new set of rules for this chapter of your life. Today, we're going to make those rules really, really simple.
So if this is you, you're probably just trying to navigate all the paperwork and the big decisions. But one of the most important, and honestly, one of the easiest to overlook, is how this whole situation completely changes your relationship with the IRS.
It's so easy to feel lost in all the tax jargon. But here's the deal. Getting these rules wrong can really cost you. Getting them right, it could literally save you thousands of dollars. And in the next few minutes, we're going to show you exactly how.
Look, we know it's complicated, so we've sifted through all the official IRS rules and pulled out the 4 most important tax decisions you're going to face. Let's start with the very first box you'll check on your tax return.
First up, your new tax identity. We're talking about your filing status. This is the absolute foundation of your tax return. I mean, it determines your standard deduction, your tax brackets, everything. It's the very first choice you make, and it's a big one.
So here's how the IRS sees it, and it's pretty black and white. It doesn't matter if you are married for 364 days of the year. If that divorce was final by midnight on December 31st, then, for the entire tax year, you are considered unmarried. Now, if you're unmarried, you'd probably think, okay, I just file a single, right? And for the 2025 tax year, that gives you a standard deduction of more than $15,000. That's not bad. But what if I told you there's a much better option for some of you? Because if you can qualify for the head of household status, that deduction skyrockets to over $23,000. We're talking a difference of almost $8,000. That is a huge tax break, and it all comes down to checking the right box. So the million-dollar question is, how do you qualify for it?
Let's dive into that, because qualifying as head of household isn't just some small adjustment. It's genuinely one of the biggest tax breaks out there for single parents. You get that bigger deduction, and you also get more favorable tax brackets. It's a game changer.
Now, as you can probably guess, the IRS has some pretty strict rules here. They don't just hand this status out to anyone. You have to meet very specific criteria. But don't worry, we can boil it all down to a simple test.
It's really just a 3-part test. First, you have to be considered unmarried on that December 31st deadline. We already covered that. Second, you have to prove you paid more than half the costs of keeping up a home for the year. And third, a qualifying person, which is usually your child, had to have lived with you for more than half the year.
So what does paying the bills actually mean to the IRS? Well, they're very specific. It's not just your rent or mortgage. It's also things like property taxes, homeowner's insurance, repairs, utilities, and even the groceries that were eaten in the home. You have to add all that stuff up and show you paid for more than 50% of it. Okay, this brings us to one of the biggest points of confusion, and sometimes conflict. Who gets to claim the kids as dependents? This is so important because it's tied to really valuable tax credits, like the child tax credit. To settle this, the IRS has a very precise definition, and it has nothing to do with your legal custody agreement. For tax purposes, the custodial parent is simply the parent the child slept under the roof of for more nights. You just count the nights. It really is that straightforward. So the general rule is super simple. The custodial parent, the one who had the kids for more overnights, gets to claim the child. End of story. But there is one very important exception to this rule that you absolutely need to know about. The non-custodial parent can claim the child, but only if all 4 of these conditions are met. A few of them are pretty standard, like being separated and providing support. But the last one is the real kicker, the one that requires action. The custodial parent has to sign a written statement saying, yes, I agree not to claim the child this year. And here's a crucial tip. That written declaration isn't just a casual note. The official IRS way to do this is with Form 8332. The custodial parent signs it, gives it to the non-custodial parent, and then they have to attach that signed form to their tax return. It's their proof. Finally, let's talk about the actual money that changes hands after a separation, specifically alimony, because the rules here have had a massive change recently, and it all hinges on one single date. Think of this as a huge dividing line in tax law. If your divorce was finalized on or before December 31st, 2018, you're under the old rules. The person paying alimony gets to deduct it, and the person receiving it has to report it as taxable income. But for any agreement after that date, it's a whole new world. Alimony is basically a non-event for taxes. It's not deductible, and it's not taxable income.
And what about splitting up big assets, like your house or an investment account? Here's some good news. Generally, the IRS doesn't treat this like a sale. When property moves between you and your ex-spouse because of the divorce, it's not considered a taxable event. So no capital gains tax to worry about at that moment.
Phew, okay, that was a lot of ground to cover. So let's boil it all down into a simple action plan. The key things you absolutely have to remember when it's time to file.
So here's your checklist. Number 1, don't automatically file as single. Do the 3-part test and see if you qualify for that much better head of household status. 2, remember, for taxes, custody is just about counting nights. 3, if you're the non-custodial parent and you want to claim the child, you must have that signed Form 8332. And 4, know the date of your divorce agreement. It changes everything for alimony.
And that brings us to one last really critical question. This isn't about last year's taxes. This is about what's happening right now with every paycheck.
You see, that W-4 form you filled out at work when you were married? It's totally obsolete now. Your new life needs a new withholding plan. Filing an updated W-4 with your employer is the single best way to make sure you're not going to get hit with a surprise tax bill next year, or just as bad, give the government a giant interest-free loan. It's a simple 5-minute task that puts you back in control of your money and your new financial future.